All right, so where to hold your cash bucket, the 2 to 3 years of cash. Here's my man Wade from Arizona. He writes in, and this is actually interesting. It concerns me to some degree because he's saying, it seems like he's insinuating that you should, or I was saying that you should take out the 2 to 3 year bucket of cash and take it out in one fell swoop from your 401k or IRA in order to put it in a cash account like at the bank, a CD or something like that. No siree, Bob. Do not do that. So basically, if all you, let's just for simplicity, you got $1 million in a 401k, and you say, look, I need 30,000 a year to live on. So I say, man, you should have we'll just for simplicity, $100,000 in a cash bucket. We'll just use that for an example. So you got $100,000 in a cash bucket. Well, let's just say I need 50,000 a year. So you got $1 million in your 401k. You need 50,000 a year to live on for 3 years. We're gonna take 150,000 bucks and put it in cash. When I say cash, my friends, I mean it needs to stay in your 401k because we do not want you to pull that out in one fell swoop and get hammered on the tax man. No. So if I wasn't clear on that, let me be as explicitly clear as I possibly can. That money needs to stay in your 401k. So what happens is now you separate it, and this is just mental accounting, which is actually a huge financial planning tool, and thus won Nobel Prizes for Daniel Kahneman and what's his name, Richard Thaler, because the whole behavioral finance, mental accounting thing. So now you got your 401k is one big account, but you're dividing it into two separate accounts. You got your growth account on the right and your income account on the left. The income account would be the stable value fund like I talked about. Hell, you can have the Vanguard money market in your 401k or in your IRA. Nothing wrong with that. I think the Vanguard money market, last time some guy told me, is like 2.5, 2.4. So just dump that 150,000 bucks in the Vanguard money market. You're really not going to get more than that of CDs nowadays with a flat yield curve. I mean, you could go out. I think somebody's telling me Ally Bank had a 2-year CD paying 3.01, I think. I wouldn't even mess with it. I just keep it at Vanguard or whatever, the money market account that you're getting or stable value fund or something like that. If I'm not getting a lot more bang for the buck by taking the time to go to a bank online or at their stupid branch, I'm not going to do that. So basically, it's just, remember, your time has a value. So if you're going down the bank to talk to some banker and they're trying to upsell you on this other stuff, forget all that, man. Now if I'm only getting 60 basis points more than I could in a liquid account with a Vanguard Prime Money Market, don't do all that. So essentially you got this barbell approach. Remember that, you got the barbell. So you got my big head is actually the bar. Right now you got the bar, the two plates. So you got 45-pound plate here, a 45-pound plate here, and you got a bar in between. All right, so you're saying my cash, my $150,000 is my 45-pound plate on the left side of the bell, of the bar. My 180, 150,000 in stocks is my right side of the bar, and that plate right there. Now, obviously, it'll be a lot heavy, but that's okay. And so what happens is now, like Wade's saying, they want to do some RVing, so they might need $50,000 in their first year of retirement to go RVing. Well, just pull that $50,000 from this plate right here. All right, so now this plate is no longer a 45-pound plate; it's a 35-pound plate. Now you're going to pull another $50,000 the next year. Now that plate is no longer a 35-pound plate; it's a 10-pound plate. And then you're going to pull the last $50,000 in year 3 out. And so now there's nothing on this. There's no plate on this barbell. It's gone. So everything is on this side now. And so now you got to start moving money from here, this plate, and bringing it back here to kind of straighten out a little bit. And that's what you should do. But I tell you, man, you don't want to do one fell swoop at all simply because it's a tax position you have to pay. Remember, I cannot stress this enough. The IRS has a lien on your property called the IRA. Now, we know that for a fact. You take all the risk and they get some of the gains. There's no other way around that. You do not get any losses on the IRA. You take all the risk and they get some. It's the exact opposite of what the banking thing was in 2008 with Bush and then what's the name, Obama, where we bailed all these bankers. All right, we socialized the risk and privatized the profits. That means the folks who got paid, all these bankers, were paid off the risk that we took on as taxpayers. The IRA is the exact opposite. You're privatizing the losses. You will be affected by the losses, but you're socializing the gain, because what happens is when you make money in the IRA, the IRS gets a portion of that. We want to reduce that as extensively as we can, and the way to do it is to manipulate your distributions to watch the 1040, watch your bottom line on your tax code on the 1040, watch your AGI, and say, My AGI is $75,000 this year. I got $24,000 of standard deductions. All right, so now my taxable income is $51,000. I don't hit the next tax bracket until I hit about $80,000. So I have roughly $30,000 I can take out without pushing me up above the higher tax bracket. So let's go ahead and take that $30,000 out so I know I can pay 12% tax on it and never have to pay tax on it again. That's how you do it. That's how you manipulate the tax code. If you just in one fell swoop say, I'm going to take $150,000 out, now you're not only going above the 12%, you're going to 22%, even to 24% at that point. So you're losing, you know, a little bit, about a fifth of what you would have had if you would have just, you know, done it in a separate, you know, $50,000 a year pop. So you gotta be careful there. Now, on top of that, if I were Wade, I'm like, man, okay, I'm gonna take $50,000 a year to live on so I can go RVing, but I'm still knee deep in the 12% tax bracket. It probably won't be, but I'm in now the 22% tax bracket, and you gotta look into the future. All right, this is where you gotta do some tax planning, and your tax guy is not gonna help you with this very often because they're so doggone busy right now. So you say, okay, I'm looking into the future. I see my taxes being higher in the future because of RMDs, required minimum distributions. Thus, let me go ahead and nip that in the bud now by slowly, if not quickly, starting to take more out of the 401k than the amount I need to spend on so I can pay a low tax rate as opposed to paying a higher one in the future. And don't forget, if you're married filing jointly, I assure you your tax rate will be higher in the future. We know this because a married filing jointly taxpayer gets 2 standard deductions and a much higher tax bracket than a single taxpayer. So I'm just telling you, do not fall for my taxes today are 12%, in the future they'll be 12%. Not if you're married, man. They're not going to be. They will be higher in the future because you are going to leave a surviving spouse who will no longer have the benefit of your standard deduction and whose tax bracket will increase. Just look at the tax code. It's easy. Single taxpayer, to be in the 12% tax bracket, you need $10,000 of income. All right, married filing jointly, to be in the 12% tax bracket, you need $20,000 of income. There you go. So if you went from $20,000 of income to $10,000 of income, and you're now going from married filing jointly to single because you died, now your surviving spouse is in the 12% tax bracket. So don't do that. All right, so you got to manipulate the tax code, but don't do it all in one fell swoop either. Just because that would put you in a much, much higher tax bracket. Now remember, I cannot stress this enough. Unless you're doing Roth IRAs, if you have qualified dividends and long-term capital gains and you remain in the 12% tax bracket, you do not pay taxes on those qualified dividends and long-term capital gains. So you got to be careful here. So you got to make sure that you're not doing something robbing Peter to pay Paul. So you say, I'll get you IRS. I'm going to start taking money out today, but I won't have to pay money on that. Just be careful. Be careful because that could cause you some consternation in the future if you're not careful on the tax code. Lastly, always remember, man, when it comes to Social Security, I'm just telling you right now, the ideal position to be in is to have nothing in your IRA or 401k, and this is for Wade because he said he's 58 next year. April 2020, be 58. So, my friend, if you could have nothing in your 401, and we talked about this, Wade and his wife, and we talked. But anyway, long story short, if you could have everything out of your IRA and 401k by the time you hit 70, and that's ideally when you start taking Social Security, you're going to be in a hell of a lot better place than someone who has everything in their 401k and took Social Security earlier. It's not debatable. I'm sorry. People say, no. From a tax perspective, it's not even close. 401k with a zero balance and Social Security at 70 is exponentially better than a 401k that you haven't touched because you took Social Security early. Because if you're not looking at the taxes on that, then you're not doing apples to apples comparison. That's not specific to you, Wade. That's just for anyone watching. We want to have nothing in your 401k or IRA when you hit 70 because you are taking it out to allow Social Security to grow at the 8% per year delayed credits with a cost of living adjustment. That's tax-free if that's all your source of income. It's a wonderful place to be, and I cannot tell you how many people are not. They do the exact opposite. I'm taking Social Security at 62, And then I'm going to start defer, because my tax guy says defer my taxes until I'm 70 by my RMDs. And oh my goodness. Remember that old cartoon thing where they had the Indian guy, and he saw all the pollution in the stream? He started crying. I think he said, I've seen the enemy and it is us, or something like that. That's the tax code, man. I've seen the enemy and it is us, because we don't look at it. We don't pay any attention to it. And then when we do, it's too late. It's too late. Or we say, oh, that doesn't make sense. My accountant says to defer, defer, defer. No, man. Defer only if there's a reason to do that. All right, so I'll stop on that bandwagon, or that rambling here. Appreciate the email, Wade, but good luck with your RVing adventures, and post pictures on the channel here. All right, we'll see you.